Risk management is by definition the identification and treatment of risk that can affect your business. Risk management is a process. How do you identify the risk, the exposure that your organization faces? And how do you tackle that risk so that it doesn't turn into a crisis? Hello and welcome to this special series on risk management ahead of the ICICI Lombard Risk Manager Awards. On the show today, we focus on risk management strategy, crisis preventive versus crisis reactive. Gentlemen, thank you very much for being here. First up, I think we need to get a few definitions out of the way because, you know, crisis can mean different things to different people. So who's volunteering for a quick definition of what we mean when we say crisis on this show?
Actually, crisis can mean different things to different enterprises. Some enterprises might take crisis as one event which can stop the company. Basically, it is an existential event. Or crisis can mean to some companies that it can delay production for a manufacturing company for 3 to 4 months, or can put the company out of operations for a couple of months or longer. So for different companies, it is a different meaning altogether. But either way, whether it stops the company or it puts it out of operation for a couple of months, it's a huge event for the company and it needs to be tackled.
Any aspects that you'd like to add on to that?
In our definition, when we do consulting, is something which is unexpected and with a huge impact. So it is low frequency, high impact event which lead to crisis.
Mr. Subramaniam? Okay, so we all agree on the definition, or were you going to add something right there?
I would like to say that whenever we say the crisis in the financial sector, we say that yes, we didn't know that the probability is very low, what he said, but the impact is huge. So therefore, the crisis is very important in our financial sector to keep on the radar to monitor it.
Which, therefore, I find myself in a sort of puzzling spot, because here we are talking about crisis. And broadly, I get the sense from you that a crisis is something which is tough to anticipate, and it's low frequency but huge impact, huge debilitating impact. Therefore, I ask a fundamental, naive question, but a fundamental question: is it possible for companies then to have crisis preventive risk management strategies? Mr. Agarwal, would you like to share your thoughts?
Yeah, in fact, every company should have a crisis preventive management strategy, because the impact can be huge. And before you arrive at a crisis preventive strategy, you need to know what are the various risks that your organizations face. And once you have enumerated that, and then you find out which are the ones which we can tackle on a day-to-day basis, which are the ones which we need to transfer to, say, some entity like an insurance company, or which are the risks in which we need to spend money so that the preventive measures can be taken. In my opinion, prevention is better than cure, as everybody knows, and it costs far less in preventive strategy than to ultimately go for a reactive strategy. But there are certain kinds of risks which are non-preventive and which you should be aware of, and it is best to be aware of and put it in that bucket, rather than be totally unaware of and be taken by surprise when it actually happens.
Okay, just to sort of expand this whole idea of what a crisis preventive risk management policy should be, and we're talking about ideally, before we take a check on what's happening here with Indian organizations, what are the pillars, the thought process behind a crisis preventive?
I think when we talk about the crisis prevention mechanism, as a business manager, we need to analyze that what are the different types of risk a business can carry. Post that, we need to have a plan in and around that what are the mitigating actions we can have against those identified risks. And then we should have an implementation plan which is clearly defined, which in our terminology we call business continuity plan, which enumerates all the detailed activity if eventually it happens to my business.
Okay.
There has to be somebody who is really paranoid about risk. It's not enough to have, there are two ways. One is to look at risk and look at it very theoretically. And second one is to practically say, I will sit and look at whether every fire extinguisher is working, whether all the agreements are in place, whether all my clients are in good shape. One client going out of business can put you at risk.
Or one supplier
can go. So there has to be some guy at the board level who is paranoid, who can get into everything, who can get into recruitment, into training, into making sure that the training goes on regularly, right? Everything has to be looked at, and there has to be that guy who is responsible. And I'm not talking of too much of financial thing, but at least the board should be aware of the risks that they need to understand and manage.
Mr. Mukherjee?
When we analyze crisis or risk for that matter, there are three things in it. One is that some of the risk is called known, so that we know the risk and we know the impact. Okay. Second type of risk, we know the risk, but we don't know the impact, the scale of impact. And third is we don't know the risk and we don't know the impact. Now, typically preventive things cannot be done for the last. We have to leave to the God or somebody to manage it. Important part is that known risk and then assess the impact. Now, to know the risk, there has to be dialogue within the organization at the very highest level and also at the business process level. So, what Mr. Subramanian was talking about, there will be certain things which is to be done at the business unit level, some of them has to be done at the board level, so that we can increase the level of knowledge about the risk. And once we know the risk, then you can assess what is the impact. Some of them which we cannot assess the impact, we can actually take insurance or something to manage that risk.
Okay, let's try and build scenarios
I
here.
would like to add over here is once you have had a dialogue, then you have to define the threshold. That means your risk appetite. So you know that this amount of risk I can take and this amount of risk I can't take. Once that threshold is defined, then you should go ahead and ask that these are the risks which fall below the threshold, so I will live with it. And these are the risks which are beyond my appetite. So either I will take some preventive measures, or I will transfer the risk, or I will think of a plan for it if I don't have enough resources for it. So this risk appetite definition is very important, and this should be discussed within the company.
And how much of a challenge is to get that risk appetite definition right?
The first thing in any organization, that the appetite needs to be defined, and which cannot be done as a bottom up approach. It has to be a top down approach, where the complete risk appetite, how much we can take the risk to do the business, has to be clearly defined.
So what, this is usually the job or the domain of the risk committee?
Not necessary. It has to be coming from the board level, and it has to be amalgamation of from a bottom, from a top, and come to a solution that this is the risk appetite we have in an organization.
Well, on that note, we're going to take a very quick break. The central message that's coming through, of course, is that a crisis can make or break an organization, and companies really have to reflect on the risks that they are vulnerable to, have a response plan in place, commit the resources, whether it's financial, which is not always overwhelming, or it's human capital to back some of these plans. More on these pillars of a sound crisis preventive risk management policy when we come back. Welcome back. No organization or business is immune to a crisis or disruption of operations and services. The question that we are asking today is, have you as a company anticipated all the things that could possibly go wrong and practiced with a plan to manage all of those possibilities? Gentlemen, I'm rewinding and covering some ground that we've already covered in our conversation so far, but here's my question, and I'm going to pose it to each one of you. If companies have to go about building a plan that is essentially risk preventive in objective, what's the starting point?
I think it is important to define what is a risk. Most of the time we define risk in very silos, credit risk, market risk, do it in silos. I think risk is something which prevents the organization to achieve its objective. So that is a broad definition. So I think organization should pose this question to the board and to the senior management. That means what are my critical objectives and what is preventing me from achieving those objectives or probable clauses. Based on that, organization can easily identify what are the risks, and then it can find out scenarios which when those risks will be materialized.
Okay, how likely is the occurrence?
Correct.
Evaluate that.
Correct.
You know, in the real world, how do companies go about doing this? I mean, do they look at what their peers have experienced? Do they look back at history? You know, what's the thought process?
See, typically we are very well prepared for the war which just got over, right? We have seen what has happened, so we are completely ready for that risk. For example, one company had a problem in Bangalore, and they asked for a training to be done only in Bangalore, because of what happened. That's not right, right? Even when you have past data, you should know that what happened in Bangalore could have happened in Calcutta, could have happened in Delhi. So largely it is reactive, saying, oh, this happened, let me solve it. It is reactive. Should it be far more preventive? Yes, it should be, but given business pressures, etc., it's not as much. But yeah, the board's charts, they understand, and then you say, okay, I'm taking the risk, I'm understanding this risk, and for this I'm getting this extra benefit. So if I want to have operations in India, I will work at an X margin. If I want to work in Africa, I may want a higher margin. If I'm earning in dollars, I may want a lesser margin, or things like that. You build all that, you put the price and say, okay, this risk I'll take, this risk I'll not take, or this risk I'll transfer to an insurance company and pay a premium.
How, draw on your experience, how prevalent is this thinking, crisis preventive risk culture in companies in India?
As it has been said earlier, people go a lot with the history. So people believe that history shall repeat itself, and what has not happened in the past may not happen. In our business, we have seen that a lot of things happen which have never happened in the past. So people will have to dissociate a little bit. History may not repeat itself, and they have to take a practical cover, which is a likely event to happen. And the most important thing is that low frequency risks are actually having the highest impact. So you have to look at the highest impact risk and take necessary precautionary measures.
What are the lessons in the financial services space that can apply to other sectors as well? And it's not so widely prevalent right now.
I think if the risk is analyzed at all the SBU levels from a bottom-up approach that try to identify what are the possible risks I carry in my particular function, and then assign that impact and probability to each of those things and take only the top 5 or the 10, that these are the 5 or the 10 I should manage as a business manager for that particular unit, and then go in a hierarchical fashion and go to the top 5 or the top 10 for the company what it bears, I think then we are there. And that needs a bottom up approach to analyze each and every activity and assign what the risk has on impact and the probability basis.
It seems to also be a bit of a dilemma for companies. The cost versus the likelihood of the outcome versus the benefit if that event occurs. It's a tough balancing act. What's the ideal way to balance?
I think what Alok has said earlier, it will be driven by the risk appetite. Okay, some of the risk you have to live with it. Suppose you are a regional bank, you carry a risk. That is the business model you are following. So tomorrow, if something happens to that region or to that particular country, you are going to suffer. So some of the risk we have to live with it as an organization. But I think risk appetite is very important, and based on the risk appetite, you can decide which of the risk you want to take, which of the risk you don't want to take.
What's the advice that you would give for people who are toying with the idea of risk but haven't really committed themselves fully?
Contrary to popular perception, the cost of risk management in all risks is not very high. Sometimes it is the management bandwidth that is required. Sometimes it is basically awareness about the risk that is required. It is not necessary that large companies do better risk management. So basically it is the management philosophy of the company which basically brings out the risk management philosophy. So there might be large companies whose risk management philosophy is inferior compared to the mid-sized or the smaller sized companies. So it is and it can be due to various factors. It can be individual driven, it can be basically a history driven because of the past history that a company might have faced. So size of the company has got nothing to do with the risk management philosophy. That is what one point I would like to mention over here.
To my mind, the continuous dialogue amongst the people are very much essential within a company to come to that risk appetite. The risk appetite word keeps on changing. So therefore, a dialogue is very important. It should not be that once in a year or once in 2 years I have a dialogue and said this is my risk appetite and will go along with. No, because the risk parameters are changing continuously. So therefore, continuous dialogue amongst the people are very much essential to mitigate the risk.
There is one person who is designated to look after risk.
Yes.
But it is not really his job. Every SBU guy, every transaction, he has to think of what is the risk for the company. Like if he's a bank, when he's giving a loan, you don't expect the risk manager to come and look at every loan, but you have to know what risk you're taking, what reward are you getting. So everybody, if the risk is instilled as a culture into every guy who is there in the organization, right from the guy who is serving tea to the MD, if everybody thinks about risk and that kind of awareness is there, there, then the number of meetings may not matter, but at least awareness is there. If the awareness is not there, it becomes more theoretical.
I suspect that's easier said than done, but we're going to take a quick break. When we come back, we'll talk about, whether it's easy to achieve a risk management culture in a company, but we're also going to focus on those crises which just cannot be anticipated. What then are the fundamentals for a company's response plan? This is what you called, Mr. Mukherjee, the unknown unknown. More on the unknown unknown when we return. Welcome back to this special series on risk management leading up to the ICICI Lombard Risk Manager Awards. There are many crises which are impossible to predict. A crisis preventive and a crisis reactive plan then becomes important, and in a sense both become equally important. We're going to continue to talk about crisis management plans with our panelists, but first off, I just want to ask you one term which we use in the context of banks, stress tests. It happened in America, and that essentially tests your fundamental resilience. How much of the stress test concept applies beyond financial services?
I think in the financial services it is a must, whereas in the manufacturing probably stress test can be done. I am not sure whether in Indian
what
context.
What is a stress test?
Having a past data and put it in a model and see with what sort of risk it can bear in a very layman word. Now, whether this thing can be done in the manufacturing world, I am not very sure, but the stress test actually helps for us to take a look that am I in the right direction or not. Is there any other thing we need to do to prevent such aberration?
And can I rephrase it to say that, a stress test basically checks how much shock a company or an organization can absorb?
Yeah, what can go wrong? First, analyze what are the things that can go wrong. What are the events that can happen simultaneously? And all plot it on a chart and blow it up to say that whether the company's net worth will be wiped out if 2 or 3 events happen simultaneously. And if so, then what are the preventive measures that we can take, or what are the transfer mechanisms that you can look at. But having said that, there is some amount of business risk which is inherent to any business, and that cannot be avoided. And for example, if somebody goes to a particular country, you can take a political risk cover, but there are certain nuances of that country which you can't avoid. And you have to take it, and you have taken a conscious call once you have decided to go to a particular country, and maybe it is built into your P&L model that you will work at higher margins because of the inherent risks of working in that country. Therefore, those kind of business risks we call in our parlance, which are inherent to our business and which are not transferable, and which can at best be you can be aware of it.
Just to go back to my first question, which was the concept of stress tests, vulnerability assessment. How far do you see it, and I address this to both of you, how far do you see that happening beyond banks, financial services?
In my experience, I have not seen much. In financial sector also, it is very limited. Most of the places it is driven by regulators, because there are certain, those test is very catchy word, it is very difficult to implement, because the first problem is that to define the scenarios, okay, and to assign a probability to the scenarios. Sometimes what people do, if I create doomsday scenarios, then I know the company is going to get closed. So I can completely discard those scenarios. So there is a balance between what completely doomsday scenario and some scenarios which are can be managed. So that is the first. And second is in most of the organization we have this good news culture. So people who create those doomsday scenarios are not popular among the organization.
They are not popular at all. Prefer not to have them speak.
Correct.
And especially in public forums. Correct. But on a serious note, coming back to the unknown unknown, correct, you still have to have a mechanism within an organization that ensures the best possible response in the circumstances. What should that mechanism definitely include?
You look at a company and you see who is the most powerful person. Is it the internal audit head? Is it the compliance guy? Is it the risk manager? Are these people important, or the business can just rough ride over these people. That is very clear to you when you see that the internal audit head or the compliance head or the risk manager does not have enough power to say this was a good sale, but they broke these laws and therefore the incentives will not be paid. If the internal audit guy or the compliance guy or the risk manager cannot do any of those things, you know that the company has a lip service for risk management, but is actually not willing to implement it. When you see a company where the incentives are all built into saying, did he do the sale properly, did he do with the compliance, did he do all this, and only then the incentives are given, you know that the company is concerned about risk management. Here they are saying, if something goes wrong, we will have a look. And whereas in this company, when they are taking precautions, obviously they may do badly in sales, but the unknown, the chances of the unknown, they are reducing.
Okay, gentlemen, we have time for final words here. It's a mouthful, but I'm going to put it to each one of you again. Put one final thought on the table before we wrap up this conversation. Risk management, crisis preventive versus crisis reactive. One word of advice finally from you. Why don't you start?
I think we need to discuss risk and we need to be aware of it. So if we don't discuss it, if we don't bring it to the table, then when it actually happens, you don't know how to react.
Discuss risk.
Risk needs to be defined very clearly for an organization or the business, that what should be my appetite.
Define the appetite for risk very clearly.
I don't see an inherent conflict between preventive and reactive, as long as you know how to react.
Okay, there isn't a fundamental contradiction or conflict between crisis preventive and crisis reactive. As long as you know how to react, the organization is somewhat on safe ground.
A reasonably implemented plan is better than the greatest plan which never got implemented. So ensuring that you have understood risk is fine, and seeing that it actually gets implemented at the ground level is far more important than just making projections and doing nothing about it.
Actually, that's an important final thought on which to wrap up this conversation. Been a pleasure talking to each one of you. Thank you very much for your time and your insights. Thanks very much.